Today, I'm going to share with you my top 9 markets where you can find great cash flow in the US today in 2023. Historical performance is not an indicator of future events. Dayton's home prices have gone up 2% over the last year, and its rent has gone up over almost 6%. If you're a renter, you've probably felt like rent has gone up a lot, and it has, above the historical average, particularly during the pandemic. Hey, what's going on, everyone? I'm Dave Meyer, Vice President of Data and Analytics at BiggerPockets, and part of my job, one of the things I love most, is being able to study different markets across the United States for their investability. It's really up to every single investor to decide what criteria they want to use to determine where they want to invest. And today, what I'm going to share with you is just one view of different markets, and that's which markets have the best cash flow potential. I'm not going to be fully evaluating all the regulatory issues, population issues, economic growth. All I'm going to share with you today is which markets in the United States, all other things aside, have the best opportunities to generate pure cash flow. This is what a lot of people are after, is trying to understand where to find cash flow, and I've got a great list for you. If you like this list, you like this video, please make sure to give us a thumbs up and subscribe to the BiggerPockets YouTube channel. Before I get to the list, I just want to talk about sort of how we got here for just a minute, about why we're in the scenario where cash flow is really hard to find. It's basically just a function of two things: how expensive houses are and how much rent is. Over the last decade or so, basically since the Great Recession, housing prices have gone up a lot. And there's a lot of reasons for this: demographics, a low interest rate environment. But housing prices, since they bottomed out in about 2010, 2011, have really gone up at a pretty historic pace. And we all know what's happened since the recession, since the pandemic. It's gone up even faster. You know, we've seen properties double or even triple in value in some locations. We've also seen rent go up at the same time, but not as quickly. And I know if you're a renter, you've probably felt like rent has gone up a lot, and it has, above the historical average, particularly during the pandemic. But compared to home prices, it's still not as much. And so when you take those two trends together, it creates worse opportunities for cash flow for real estate investors, because so much of the expense of owning a rental property is your purchase price, right? Those are very large prices. Your mortgage is usually by far your biggest expense. And so because when you buy a property, the price of your mortgage has gone up and up and up, and rent has grown, but not at the same pace, that means that the opportunity for cash flow has declined. One way to measure this, and the way I'm going to sort of evaluate the different markets in just a second, is based on something called the rent to price ratio. This is a super simple metric. Anyone can calculate it. All you need to do is divide 1 month of rent in a certain market by the purchase price in that market. So if you, for example, had a market where the median home price was $200,000 and rent was $2,000 a month, you would have a rent to price ratio of 1%. Anything that's around 1% for a rent to price ratio, which I also call RTP, so anything as an RTP of 1% or above is phenomenal. You can't always expect that. Sometimes you need to go a little bit below that. Just so you know, that rent to price ratio on a national basis has been falling for over a decade. You know, what we saw was during the Great Recession, home prices plummeted. Rent actually stayed pretty high. So for a couple of years there, from like 2009 to 2012, there was like this glory time, this sweet spot where cash flow was really, really easy to find. But ever since 2012, it has been declining. And since the pandemic started, it has really declined even further. So that's sort of why we're in the situation where cash flow is hard to find. Things might be changing because the housing market is in a correction and prices are coming down, and rent are probably not going to go down as much. So we could see an improvement in cash flow conditions over the next couple of years. But for now, it is still kind of difficult to find. So I'm going to share with you my 9 markets that have the best rent to price ratios in the United States. And I know, listen, if you're an investor, there are many more criteria you need to factor in as part of your decisions where to invest. Like I said, you know, regulatory environment, population growth, economic growth, all sorts of different things that you need to think about. My goal here is just to help you understand some of the markets that offer great cash flow. And then what I recommend you do is evaluate them further to see if, they meet your other investing criteria. With no further ado, I'm going to go with my number 9 market, which is Rochester, New York, which is where I went to college. So I have a fond affinity for the city. It has a rent-to-price ratio of 0.78 and a median sales price of pretty low of $167,000. So that is relatively cheap for the Rochester for this market, which is really beneficial for anyone who wants to get in at a low price point. I just want to make one more comment. I should have mentioned this earlier about the 1% rule. A lot of people think that you can only invest in deals that meet that 1% rule. I personally don't believe that. I think that 1% rule was created during, 2010, 2011, that magical time of cash flow. I think if you find something above 0.7%, 0.8%, it could offer good cash flow. And this is particularly true when you're evaluating markets, right? Because if the rent-to-price ratio for all of Rochester, New York is 0.78, that means by rule, because that's an average, that means that there are deals that are worse than 0.78 and there are deals that are better than 0.78. And as an investor, it is your job to go out there and find the ones that are better. So number 8 is Little Rock, Arkansas, which is just a little bit better at 0.79 rent to price ratio, so barely. But what's really great about Little Rock is that the entry point is only $130,000. So that is very, very cheap. But I will caution you, and again, this is why I'm saying this is just one metric to look at. Little Rock has seen their prices go down over the last year 4%. So if you're going to buy in Little Rock, Arkansas, be wary that prices may be coming down right now. Number 7 is Milwaukee, Wisconsin, which also has a 0.79% rent to price ratio, a slightly higher entry point at $175,000. And it also has seen prices decline in the last year of 1.5%. But on the other hand, Milwaukee's rent is still going up 3.4% a year, which could bode well for future cash flow if that trend continues. Number 6 is Dayton, Ohio, again at 0.79. Man, we have 3 markets at 0.79 rent to price ratio and a low entry point of $134,000. Dayton's home prices have gone up 2% over the last year, and its rent has gone up over almost 6%. So if those trends continue, that would be a really interesting market for you to check out because there's good cash flow potential and things are still growing. Number 5 is one of the biggest cities on the list. We have Philadelphia, Pennsylvania, with a rent to price ratio of 0.86%. It is the highest entry point of any market on this list at $200,000. And sales prices have started to decline, but rents are up over 5% year over year, which is really, really good. Number 5, I'm at 4. Number 4 is Birmingham, Alabama, which does meet the 1% rule. It's our first one on the list that meets the 1% rule at 1.02%. Sales growth has gone crazy over the last year. It's in the double digits, but rent is starting to decline. Number 3, Cleveland, Ohio, also beating that 1% rule at 1.03%. Super low entry point at $125,000, but Cleveland is really interesting because sales prices are still going up, but rent is starting to go down, which is a little bit unusual right now, something you'll probably want to keep an eye on if you are looking at the Cleveland market. Number 2 is Memphis, Tennessee at 1.04 rent to price ratio, again beating the 1% rule, but Memphis has seen sales price really start to decline and rent, so be careful in a city like Memphis. It does offer good cash flow, but you don't really want to catch a falling knife, as they say. If Memphis's home prices are still going down, it doesn't mean you can't buy there, but when you go and buy in a market like that, you want to make sure that you're offering below the listing price, right? Because if you think that property prices in Memphis are going to go down another 5%, make sure that you're bidding 5 or maybe even 10% below the list price to protect yourself in case that prices fall further. Number 1 is Baltimore, Maryland, with a rent-to-price ratio of 1.86. It nearly meets the 2% rule, which is crazy. The entry point is under $100,000. Sales growth is at 7% year over year. Rent growth is at 5% year over year. Those are all phenomenal stats. Now, there is no knowing. Historical performance is not an indicator of future events. We don't know if these things are going to continue. But if you just were looking at a snapshot, which we're offering today, Baltimore, Maryland is an incredible place for cash flow because it has that 1.9% rent to price ratio, a very low entry point. Sales and rent are both going up. And so if those trends continue, that would make for a very good investment. Hopefully this is helpful for you. If you do wind up wanting to learn more about these markets and do any research and have any questions, make sure to post them in the comments below. If you have any feedback for me about this episode or any ideas about future markets that you'd like me to analyze, make sure to hit me up on Instagram where I'm at The Data Deli. Thank you guys so much for watching. Just as a reminder, reminder, every 2 weeks, so every other Saturday, I will be doing these videos where we talk about specific markets. So again, if you have any ideas about that, hit me up on Instagram and make sure to tune in 2 weeks for my next video. Thanks.